Hello and welcome to the Investors Champion podcast. The goal of this podcast is to give you a quick but informative rundown of some interesting topics affecting UK investors and a rundown of the biggest movers in the UK share market, including AIM and some bonkers bargains for you to take a closer look at. Let's get started. Well, Chris, good to see you again.
Hello, Lee. Nice to be here. I've just watched some amazing bouldering in the Olympics. Incredible. You like your climbing, don't you?
I do, yeah. Well, living in the Lake District, it'd be a shame not to enjoy the many benefits of living close to that sort of environment. So yeah, I do enjoy getting up there and a bit of climbing.
Yeah,
I'm not sure I'm at that level though. I'm not sure I can do Olympic level.
Hold it. At least you have the weather to put up with. It was absolutely perfect weather. When you're on a sheltered wall just outside Paris, or not as volatile and frosty as it might be when you go out.
Definitely, we have to contend with the weather way up here in the north. Yeah, but we nearly didn't do this episode, did we?
I know. Yeah, I was tempted to jump on a train and go out, but it proved quite pricey for one night. It wasn't just the tickets. When you stayed, the cost of the train, everything put together, it was quite a lot for relatively small exposure to the Olympics. One of my daughters had a great time out there. She saw loads of events, had a fantastic time. She said it was absolutely brilliant, really well done, loads of things going on. Paris was very welcoming, which is pretty unusual in itself. So yeah, great, fantastic event.
Yeah, so been an interesting week, hasn't it? And we thought we'd dive a little bit deeper into some of the news that we've seen this week, and indeed how you've approached it as well, being a seasoned investor. The recent crash, can we call it a crash?
Well,
Really?
a mini crash.
A mini crash.
The Nikkei, Japan's Nikkei had a crash on Monday. It absolutely tumbled. It went 12% in a day. It's the worst day since Black Monday crash of 1987. So this was it's pretty severe. The Nikkei had a brilliant year. It was chugging up. Everybody was loving Japanese stocks, and bam, it lost all its return in a morning. But this was on the back of news on the previous Friday's news from the US and concerns about the jobs. They saw employers not adding as many jobs as were anticipated. It fell well short of what people are expecting, and also unemployment ticked up in the US. So it was as always bad news from the US on a Friday. Then we opened in Japan on Monday. You've got all this wacky carry trade where people borrow in yen because it's cheap and go long US dollar. It's a weird carry trade, and everything's started tumbling. But clearly the biggest impact was felt by all the technology stocks, the stocks that had all been flying. So the Nvidias, Microsofts, Alphabets of this world got badly hit. And some people said that the sell-off also was exacerbated by the news that Berkshire Hathaway, Rogers Buffett, had sold a big slug of Apple stock in the previous quarter. So he offloaded nearly 50% of the holding in Apple, worth about $80 billion. Still holds that. $80 billion is an awful lot of Apple shares. And everybody had thought that Apple was going to be Berkshire Hathaway's holding forever. So this may have contributed to things. Who knows? I'll tell you what was interesting as well. Everybody thinks crypto is a sort of alternative play, yeah? All crypto and Bitcoin tanked as well. Absolute rubbish that it's uncorrelated.
Crypto is clearly correlated, isn't it?
Yeah. It's just rubbish, isn't it? When people say, oh, it's an alternative asset class. Yeah, it's just stupid.
Is there anything that's truly alternative in the way the things are today?
Not really. It was gold, a safe haven. It's Swiss franc. That seems to be about as bulletproof as anything.
Yeah.
I don't know.
Yep. And the VIX, I had a look at the VIX.
The VIX is, some people, it's fear gauge. It's a fear gauge after it's happened.
Yeah.
Some people look at it and think of it as a predictor. It doesn't predict anything. All it does is reflect what's happened. You've seen what's happened by then. We had a chap who used to run a fund. It was just fund trading options. It was the most high profile, scary product you've ever seen in your life, honestly. And every person I spoke to about this, the first question they would say, this was how the conversation went. Oh, I hear you've got an options fund. The response would always been, has it blown up yet? And normally I said, interesting you say that, because yes, it just has blown up. But this guy used to always refer to the VIX because it's all geared around put and calls options, traded options. And I just got sick of it.
So the moral in that story is, if someone says they're running an options fund, run a mile.
Run for the hills. Yeah.
Yeah. See, that's a good lesson in itself.
Yeah. But yeah, what do you do in these sort of times? You see everything's falling around you. We run some general portfolios as well as AIM portfolios. And our AIM portfolios, you'd expect them to be particularly weak, not as bad almost as the technology sector was experiencing in the US, which was somewhat encouraging. And the UK market as a whole, for once, benefited from not having exposure to technology stocks. We've been whinging about the fact, we haven't got any technology, the UK market's going nowhere. Well, actually, the UK market broadly is flat on the week. And now, by the end of the week, actually, even the US market had a massive rebound on Thursday, and it's not far off where it started. So, really, is it much to do about nothing? But yeah, question, what do you do?
Yeah, from someone who's been investing for many years, I'm sure you've probably seen many event situations like this because the media blows these things up. It's all about generating clicks, isn't it? That's what the media's business model is. And fear sells,
Oh, yeah,
doesn't
yeah.
it? But for the newer investor out there amongst us who's maybe listening to this podcast, how do you view it?
Well, but yeah, the press starts peddling that as well. So what do you do? Our view is you look at the strength of companies, the economy generally, and you focus on what maybe you can control. And if you're holding shares in businesses that look incredibly resilient, why should you react to this? Admittedly, some of the technology stocks are looking pretty fully priced. So if there's a general weakness creeping in and you can see some economic weakness, okay, then there may be indications that there are problems ahead. And people are going to take profits. When a stock's been flying, when an Nvidia's doubled in quick time or trebled in quick time, it doesn't take much for people to want to say, whoa, I don't want to lose everything I've gained. So bang, they're out. And the other issue with a market sell-off like this is it's often computer machine driven, algorithmic trading kicking in. So falls become exacerbated. They trigger more selling. So selling triggers more selling. It's just totally crazy. The best thing to do in times like this is often nothing. Or if one of your less punchy valued stocks has also fallen and you've been keeping an eye on this company for a while, maybe it's a good time to buy. If you see that their business is looking quite good, but their shares have been sucked in with the general market sell-off for no reason whatsoever, it's a good time to pick up bargains. You may have been looking at things thinking, oh, it's a bit toppy. Now it's suddenly 10% cheaper. Deploy some of your excess cash, and people are sitting on a lot of cash. They've been earning a lot in the bank, or a lot more than they used to. Could be a great time to buy some good companies.
Yeah. The majority of the companies that you're invested in predominantly AIM anyway, aren't they?
Yeah, a lot of small caps and AIM. We do hold some larger blue chips, but a lot of smaller companies. Clearly, people haven't been in favor anyway, so they're looking quite attractively valued. And if you have a sort of irrational sell-off like that, some of them can be particularly weak. It's a good time to buy.
Mm.
Often in the microcap world, where people are feeling a bit fragile, oh, I don't want to hold my AIM stock now, everything's going wrong, out they go, they'll sell at any price, and you can pick up some decent bargains.
So it could be a good buying opportunity on the
Yeah,
horizon.
yeah, I think so, in the right place. Well,
Yeah.
think about it carefully.
Yeah, agreed. Just circling back to Berkshire Hathaway and Warren Buffett selling half his Apple stock. Am I right in saying that the Apple stock has grown to 40% of his portfolio?
Apple, I think, was 40% alone of the overall stock portfolios. It's huge. It's a huge
Yes.
position. He bought the shares at a fraction originally where they are, so there are huge gains. The issue for Berkshire as well is when they sell the stock, they're going to pay huge tax on the gains. So there is this aspect holding him back probably from selling. But clearly he thought then was a time to sell. What's all the more staggering with Berkshire Hathaway now, their cash position is just ludicrous. In its latest earnings report, Berkshire announced that it has $235 billion of treasury bills on its
Wow.
books. That's more than the US Federal Reserve.
Wow.
The Federal Reserve at the last count had just under 200 billion. So Berkshire Hathaway is holding more in T-bills than the Federal Reserve. It's a staggering position. So if things really do fall, the Buffett Brigade and Berkshire Hathaway are going to be snapping up stocks given their cash pile. They're going to be eager buyers if we have a really big sell-off. They've got a
Yeah.
lot of ammunition.
Isn't it? Is that what they're positioning themselves for? Are they anticipating something? Well, who
That's
knows? Who knows?
it's an interesting thought. But yeah, it's the only winners at times like this, as always, the lawyers, if there's anything untoward going on, and the traders. The
Mm.
traders are making money hand over fist by manic trading, huge amount of volatility. They've been eagerly anticipating a day like this, as long as they're not haven't got too much exposure. But it's great for them, isn't it?
Absolutely.
Trading. And volatility's been low. There hasn't been much activity. So boom, you have a lovely, lovely bigger payday halfway through the summer.
Yeah, I mean, no one has a crystal ball, but do you think that's it over now? Are we over the worst of it?
Yeah, we're not through it all. And summer is also difficult. August is generally a difficult month. So yeah, watch this space. A lot of people are away as well. So it's always a bit of a difficult period. But I don't think it's good to panic and run around like a headless chicken. You just got to stick to your guns and focus on what you can control and assess properly, which is often in our respect, the underlying companies and their outlook.
Speaking of outlook of companies, Google's just lost its antitrust case in the US. Is that a concern for you?
I think it's pretty serious, this one. I mean, a judge has deemed Google to be a monopoly, monopolizing digital search, pushing out competitors. What's staggering is it was noted that Google's been paying Apple $20 billion, or $20 billion in 2022, wasn't it, to be the default search engine on Apple devices.
Mhm.
Nobody else can pay that sum of money. It's
No.
a huge sum of money. And 90% of all search queries went through Google. On the other side, Google, it's a great service, isn't it? It offers you so much for nothing. Okay, you've got to give away some of your data and your information, but if you're happy to do that, there's not a lot to complain about really with Google. But this is quite serious, and it's not clear at the moment what the outcome will be, what the judge may demand in terms of remedy. But like all these things, as it was with US versus Microsoft many years ago, it goes on and on. There's appeal after appeal. And over the time, it then gets watered down, and Google or Alphabet will start doing things that are more acceptable anyway. But yeah, an interesting situation.
Did it actually change anything when it was the US versus Microsoft? They've still pretty much got a stranglehold on the operating systems of
Exactly. It just
all the computers.
maybe it's accelerated their reasons to go elsewhere, look elsewhere, which they've done very well from. Talk about break up. Can you realistically break it up? I don't think so. That wasn't the case for Microsoft. That's what they were fearing with Microsoft, to break up Windows, strip it out, but nothing happens. It'll save, if Google hasn't got to pay Microsoft $20 billion, it's going to save them an awful lot of money
Yeah,
anyway.
Apple isn't going to pay Apple.
Yeah, Apple, sorry, $20 billion. Yeah.
How do you think that'll affect Apple's $85 billion a year comes from their business services, which I guess 20 billion of that is from.
Yeah, it's substantial. You're right. It's substantial. So, and I don't know if it was known the amount of money that Google was paying Apple. But yeah, it would suggest that Google has got a monopoly position. Well, everybody knew that, and they were probably, it was a monopoly that everybody was quite happy about, the user base anyway.
Yeah, I do wonder how much of it is because Microsoft, who now has potentially an alternative search engine in ChatGPT, is now lobbying the government to look at Google's.
You think there's some dirty tricks going on behind the scenes as well?
I wouldn't say that. I wouldn't say that, but
maybe,
you know how it works.
Maybe. And this is at a whole different level, isn't it? These technology groups are running the world, and they're bound to get closer scrutiny, growing more and more scrutiny by government, that's for sure.
Yeah. Next time there's a major sell-off, or if the sell-off continues, the general consensus is do nothing, evaluate the companies. If you think you've got good companies going into the market sell-off, does it provide a buying opportunity?
Yeah, absolutely. We're company investors. We invest in companies and the people running them often, and it's a great opportunity to think carefully about what you're holding. As you say, they look good, buy more.
Should we move on to the UK then now?
Yeah.
Look at Hargreaves Lansdown. It looks like the takeover is going through and they're going to be leaving the stock market.
Yeah, I think this is a weird deal. Private equity with the backing of a Middle Eastern government as well. I think one of the funds, Hargreaves Lansdown's one of the founders, are in agreement with the deal. Peter Hargreaves still owns 20% of the shares. He's going to sell half his stake, but carry the rest into the private vehicle that's buying it. But this Hargreaves Lansdown is a huge business, and it's been struggling of late, but this is a £5.5 billion takeover. It's still a massive business, and it's now going to be off the market, which is disappointing. And the takeover price is nowhere near where the shares were, where the valuation was a few years ago. People say it's lost its way. It'll be interesting to see the buyers. They've got clearly different ideas. They've sold a good story to Peter Hargreaves, who's sticking along with it. He's been disappointed as to how things are going. But yeah, this business, 155 billion client assets under administration and stroke administration sometimes, and a bit of management as well. But this 155 billion, so it's a huge player in the UK market, albeit its overall share is still quite small. Yeah, so it is a pretty big deal. And it'd be sad to the London stock market to lose another sizable company with nothing of this size to replace it.
Does Hargreaves Lansdown just offer other products, or does it actually manage a percentage of that money as well itself? Does it have its own fund managers?
Yeah, I think it has a small management business. It has its own funds as well, which it manages, most of which are fund of funds. Right. But it's essentially a platform that you can buy and sell shares on, and buy and sell funds on. Primarily it was funds. It's also got a nifty cash management business, and it's been making a lot of money off the interest margin on cash. Ever since interest rates have gone up, it's making a huge amount of money on effectively its clients' cash. So it secures interest on them, but only pays back to the clients a smaller element of that. I don't
It's
think
naughty,
that's
that.
very good.
That's
Yeah,
naughty.
clearly they weren't benefiting from this interest fee before, and without it, their returns would have been absolutely slaughtered
Mm.
of late, given the declines. So I just think this whole area of capturing interest on client money is really bad and needs to
Yeah.
be addressed. I know that may mean that Hargreaves may need to charge higher fees, as will all the other stockbrokers, but at least it's more visible and you can see what you're paying for then. Because at the moment, it's very opaque. You know, a lot of people won't realize that they're making that much money off the client's interest. It needs to improve its technology. People say its technology has fallen behind others,
Mm.
spend a lot of money in it to upgrade it, but it hasn't been seemingly been very well spent.
Mm.
So what are we going to see the new owners do? Maybe they're going to have to put a lot of money into investing in it and getting up to scratch. I don't know.
Yeah. And then sell a good story and make a profit.
Yeah, absolutely. As always.
Just following on with the stockbroker theme there, what's your thoughts on Jarvis Securities? Because that's who Fundamental uses as their execution platform, isn't it?
Yeah, this is a business that it leads on from the Hargreaves story. Well known to us, our firm is a client of their Model B service, so we're very familiar with this business. It provides stockbroking to both retail investors, but also it provides the platform and the back office support to small institutions like our firm, Fundamental Asset Management. And I just think it's had its problems. It's had a skilled person review, which was imposed by the FCA. Again, it's making a heap of money out of interest on clients' cash. Its argument for that is that we're winning there, and that's the way we can keep our trading costs low. So we only charge you $5 to trade a share. We'd have to increase that if we weren't benefiting. Fair enough. At least, as I said before, perhaps it's more visible. But, you know, the concerns with the issue with a company like Jarvis is it's delivered exceptional returns over the years. And this isn't just for Jarvis. Perhaps it's an indicator for other businesses as well. Exceptional returns, incredible operating margins, incredible returns on capital. It ticks all the investor boxes. Huge dividends as well, special dividends. The founder owns more than 50 odd percent. Andrew Grant, but could it be been investing more? Are those returns too high? Could it have been reinvesting some of the surplus cash rather than paying it out of dividends, for example, in improving its systems and controls, which wouldn't have therefore resulted in this skilled person review? This is pure conjecture, but I think it's a lesson perhaps that when business sometimes make exceptional returns, you've got to also perhaps see how much they're investing in the future. The risk is with Jarvis, it wasn't making investment in the future to support future growth. And maybe that was a bit of a red flag.
So is the share price struggling because of the skilled person review then, or because the company is struggling for other reasons?
The skilled person review resulted in it losing a lot of its Model B clients, some of the less reputable ones. It basically had to say that we can't support you anymore. You're not doing the sort of business we want to do. So they left. That in turn resulted in lower trading volumes because these businesses weren't there.
Yeah.
Clearly, the market's been stock market's been quite subdued. So trading commissions have been low, volume's been low. However, on the other side, it's also had a lot of cost. It has to pay. So the FCA comes in and says, we're not happy about things. You need to appoint a skilled person. They have to pay for the skilled person, not the FCA,
Right.
the company. And this has gone on now for nigh on 2 years. So the skilled person looks at one area. Now it's subsequently looking at the interest they're earning on client cash. So the poor old Jarvis has had to pay for all of this. And thankfully, in this period, interest rates have risen quite substantially. So it's made a lot of money on interest on client cash. So that's somewhat mitigated all the costs of things. But yeah, it's got to work out a way of growing out of this. If its system's suitable now and more robust, it needs to work a way out of what's the future, or what's our strategy to grow this business now.
Does it just mainly focus here in the UK, or is it international as well?
It is. You can trade international shares on their platform. They're a bit more expensive, but it's most of their client accounts are traded UK stocks. Clearly, the UK market as a whole has been somewhat unloved. We have a good service from them. Fundamental as in they have a nice, simple, stripped down service, quite basic. Again, perhaps they could offer more bells and whistles, more sort of reporting pieces for it. But yeah, it's generally a decent, robust service. But they've got to work out what the future brings us, in our opinion.
Shall we move on to some good news? And that's the UK housing sector. UK house prices have risen again more than expected in July, which is really good, 0.8%.
Yeah, so this is all good news. We need a fluid housing market. Without that, it all grinds to a halt, especially in the United Kingdom. But yeah, so that's positive. More rate cuts on the horizon from the Bank of England as well, hopefully. That might encourage the housing market a bit more. But elsewhere in the sector, the very active UK competition regulator, they seem to be all over every business at the moment. The CMA, Competition and Markets Authority, has said that it's concerned about the merger between Barratt, UK's largest house builder, one of the UK's largest house builders, and Redrow, another big player, slightly smaller than Barratt, but another big house builder. So it said, we've got concerns about that, about substantial lessening of competition. So that might be tricky. Barratt might have to do things to remedy that, to keep the CMA sweet. But yeah, it's pretty active, the house sector, and a key component of the UK economy.
Yeah, it is a massive component of the UK economy, isn't it? And last week we discussed companies that may benefit from the rising housing markets. What other companies are there out there that could benefit from this? Because it's such a big sector, isn't it? It's such a big cornerstone of the
Yeah, it
economy.
is. This week, one of our stocks, or a couple of them, one of them we've had a holding in for a long time, Property Franchise Group.
Is that in IC or the fundamental?
Fundamental, yeah, that's right. Fundamental are the associated investment management businesses that are stake in property franchise for a long time, and it's recently merged with another rival, broadly the same size, called Belvoir. So it's a bigger business, and it's the UK's now largest sort of franchisor, mostly lettings. Has a lot of lettings agencies around the country, for which it provides its lettings agents, its franchisee, with the platform and all the systems to run their businesses. And it's also made another acquisition. It acquired an estate agent. But property franchise is the sort of business that will do well out of a more benign interest rate environment. And if the housing market pops up, it's the sort of business that could do really well. And the enlarged platform it's got now, it's got more of a financial services element as well, because the Belvoir bit did. That could serve it in really good stead. So yeah, look for Property Franchise Group. It's about a 200 odd million market cap business now, so twice the size it was before. And it looks that's going to do nicely if interest rates keep falling.
Yeah, and I guess with the merger, they must be able to potentially, if the merger goes well, strip out costs.
Yeah, you're right. They were each of them were a bit subscale before, both carrying as you say, lots of PLC costs. You can cut those down as well. You've got just one business for starters. So that could be helpful. And as I said, Belvoir's got this bigger financial services piece, which Property Franchise wasn't as good at. And that means the combined offering is really quite powerful. So we have to keep a close eye on this little business.
Yeah, and you're happy to keep holding them, I take it.
Oh, yeah, we like them. And it's good that the merger was done. They were knocking it around a few years ago and it didn't work, but clearly the management could see the benefit, and hopefully it'll go on to do greater things.
Yeah, fantastic.
And also lots of our bonkers bargains.
Yeah, which ones?
I'll have to sign up and look into it. Lots of our bonkers bargains. No, I'll mention one. There's a little brick company, one of our bonkers bargains, a little brick company called Michelmersh Brick. We hold the shares fundamental as well in our AIM portfolios, in our AIM income portfolio. It should do well out of a more positive, stronger housing market. Clearly, we're short of brick in the UK. Michelmersh is at the specialist end. The valuation looks cheap. The balance sheet's in great shape. Offers a nice dividend. It's well invested. It's a really nice little business. And brick is almost closed shop. You've only got, I think, 3 UK brick manufacturers left. There's one Austrian-owned one, but that's it. The brick market is really poor people run it in the United Kingdom, and we also have to import a lot of bricks. So I think that's bonkers the other way. Why on earth are we importing bricks? Transporting great things like that from Europe, it's just ludicrous. Surely we can make our own bricks.
Yeah, I agree. And then we talk about CO2 and things like that and climate change. We can produce that sort of stuff in our own backyard.
No, so encourage it. Don't put barriers and give them incentive to produce locally rather than, as you say, consume CO2 and plenty of energy, bring it in.
Yep, agreed. Something that we've seen a lot of, Chris, recently is share buybacks. And I'm just wondering, what's your thoughts on share buybacks and why do you think we're seeing so much of it on AIM and indeed the FTSE 100 and FTSE 250 as well? It's not just AIM, but there seems to be a lot of companies that are choosing to go down the share buyback route as opposed to reinvesting in the company, special dividends. What is it that you like to see, Chris? What do you prefer? What's your thoughts on share buybacks?
I often prefer to see a special dividend. Then the investor can do what they like with the dividends. They want to reinvest it in more shares, fair enough. All right, the companies don't see that as very tax efficient. So this buyback mania is on AIM. I've never seen so many, as you suggest. It's exceptional for a so-called growth market with so many companies that you'd think might need the cash to support growth are using excess cash to buy back their shares. I think I counted one day this week, 12 companies were buying back their shares on AIM. By my estimation, it's even worse on the FTSE 100 and FTSE 250. I don't know what the percentage is, but at least 15% of those companies seem to be buying back shares, which, if you think about the logic of this, is naturally shrinking the UK stock market.
Yeah.
Companies buying back their shares, reducing the shares in issue, and therefore the market is shrinking as a result. So they're not really helping the cause.
But it would be driving up the share price, wouldn't it?
Conceivably, it's propping up the share price. So there's always a buyer out there and acquiring shares. Clearly, those remaining shareholders have got in the company have got a big greater share of remaining earnings, a greater take on the dividends. But yeah, is it driving shares? It's underpinning shares when there's little volume, but the companies are buying back their own. They become the buyer of choice of a company's shares. It's particularly relevant on AIM because AIM, this is an illiquid market, which is becoming even less liquid due to the company's own actions. And what really annoys me, and if it does happen, is some of these businesses in the past instigated a share buyback, bought back their own shares, cancelled them, and subsequently they want to do a deal in 2 years' time, gone back to the market to raise a load of new money at vast cost. If that's going to be conceivably happening, they shouldn't really be buying back their shares.
Why would they choose to do that as opposed to either sit on the cash or to reinvest in new technologies or new revenue streams, perhaps, or do a special dividend? Why would they choose to buy back shares? Or
a company may perceive its shares to be cheap. So it's got excess cash. Where can it deploy the excess cash? The greatest possible return, buy back your shares. Clearly, buying back shares reduces the share count. Therefore, going forward, it enhances the earnings per share, being cynical here, on which many companies' management incentive schemes may be based. So if you juice the earnings per share by buying back your own shares, you're going to have a better chance of meeting your earnings targets. Therefore, you're going to get your bonus, get your options, and you're going to be a winner as the management. They're quite efficient. That they could inject greater efficiency into the balance sheet as well, reducing the share count that makes the balance sheet more efficient, helps drive return on capital as well. So there are lots of good reasons, but a lot of companies prefer dividends or excess dividends. Some, especially founder-owned ones with a lot of legacy family shareholders, they might prefer special dividends or an extra dividend rather than to reduce the share count.
suppose from the AIM side of things, perhaps you'd prefer to see the investment in growth opportunities, wouldn't you?
Oh, I'd much prefer to, as long as it's spent wisely. I'd
Yeah, of
much
course,
prefer
yeah.
them. And that's what's frustrating. Should you be giving, all right, being really cynical, should you be giving a tax break as well to a business that's buying back its own shares? If it's got excess cash, should be using that cash to support, as you say, support growth. Yeah, and buying back shares isn't really supporting growth. It's only supporting shareholder returns rather than real growth and progress. Should you therefore be using all your cash to achieve more positive ends, and that's i.e. support future growth? It's a
Yeah.
discussion to be had. It's an interesting one for AIM in particular.
Yeah, and it doesn't seem there's any right or wrong answer as well. There's
I think the most ridiculous I see is when companies, especially smaller ones, effectively buying back shares out of debt. They're paying a lot on their debt. They're not benefiting from very modest interest rates, so they're paying a lot on their debt and decided to implement a share buyback scheme as well when they haven't actually got they haven't actually got net cash in the bank. I
yeah,
just
pay
think it
the
starts
debt
looking
down.
yeah, exactly. It just starts looking ridiculous. But that's my simplified view of things. I can't understand the rationale. I would implore anybody that's really interested in this. The only company I'm aware of that really puts its case better is Next, as in Next PLC, the clothing retailer, and they have a disciplined process for share buybacks, and they clearly communicate that, and they can really well, which others don't seem to follow. A lot of the others are driven by randomness rather than a distinct process.
Yeah, that's where the cynic comes out, isn't it? And then you start
Yeah.
to think, they're doing it just to meet their targets so they can get their share options and things like that.
Yeah, absolutely.
Yep, and that's something that we'll probably never really know. But anyway, as we come to the end of the podcast, we thought we'd finish off with a conversation around the AIM IHT portfolios. And you were sharing with me the reasons why you set them up, which I found really interesting. And I thought, make a great talking point, this, Chris. And, we should share this with the audience, why you set these portfolios up. Fundamental didn't always have an aim for IHT income. And I thought it'd be good to share the reasons why you set them up and equally how they are actually doing, how they're getting on.
Yeah, we identified at the end of 2022, there were lots more good quality AIM companies offering decent dividend yields. we as in Fundamental, aim for high yield portfolio a decade or so ago, and you never had the high enough quality of AIM companies. There are a lot of very small ones offering dividend yields that weren't very substantial. Fast forward now, and you've had a lot of more substantial AIM companies, more reliable dividends, more credible companies, and it looked like an opportunity to us. So we as in Fundamental launched this AIM for income portfolio. Typically AIM is for growth. These are still growth stocks, but their dividend yields were higher than normal. The dividend yield on the 30 stock portfolio that Fundamental offers is about 5%, which is pretty attractive.
Yeah.
Often they're well covered by cash as well. So the Investors Champion launched a watered down version of it. They run this AIM for high yield portfolio, and we kicked it off in October 2022. It's a reduced version of our discretionary one at Fundamental, 16 stocks. The lowest market capitalization is about 50 million, goes up to about 300 odd million, 400 million. It's a bit smaller than our growth portfolio in terms of average market cap, but it's been doing really well. We're really pleased with it.
How well? How well has it done?
Well, in the last 6 months, the portfolio, and this includes dividend income, so in the 6 months to the end of June, if we cut off June, half year, it rose 12%, including dividends, and the AIM index was barely had its head above water. It was up 0.13. That excludes dividends. If you add about another 2.5% dividends to AIM index, so you're broadly up about 2.5%.
Yeah.
So the portfolio's massively outperformed. It's benefited from a few really strong holdings that have done really well, but we haven't had too many disasters. We've had to trade out of a couple of stocks that we were a bit wary of in its existence. And one of the portfolio's companies, K3 Capital, which was an early holding, got acquired by private equity quite soon. So yeah, we're pretty pleased with it. Since inception, it's returned just under 31%. Since inception in October 22.
It's impressive.
Really good.
For an income portfolio as well.
Yeah, it's been really positive. So you've had decent dividends and you've had decent growth. And on fundamental side as well, our AIM income portfolio model is outperforming a little bit our growth. So it's reflected in that. You've had better returns out of the Investors Champion 16 stock one because the greater concentration of certain winners driven their performance, whereas the fundamental one is less volatile and there's a lower weight of holdings. But yeah, it's interesting. I would implore people to take a closer look at AIM as well for income. You can get some decent dividend income there, quite reliable dividend income.
Do the stocks that you've got in the IC, do they qualify for the IHT?
They do, yeah. They're all business, the best of our knowledge, and they're all business relief qualifying. So yeah, for those looking to mitigate inheritance tax, they could be an interesting option for them. But yeah, lots of interesting companies. I mentioned one of them earlier. Michelmersh Brick Holdings is one of the constituents of that, and that offers a nice, reliable assets, a business with lots of assets, Michelmersh as well, which gives you a little bit of extra security.
If you are interested in the AIM for high yield portfolio, you want to have a look at those stocks that are in there, the link to join Investors Champion is just below in the show notes. So scroll down, click the link, and you can sign up. Shall we leave it there then, Chris, for another week?
Yeah, a good one as always.
Thanks, Chris.
Thanks very much.
Well, that's it for today. Please subscribe for next week's episode as we will once again discuss global events, the UK share market, and some more bonkers bargains for you to take a closer look at. If you want to take a deeper dive into any of these topics and indeed more exciting and interesting companies, then please feel free to visit investorschampion.com to learn more. All the links are just in the show notes just below. Many thanks for listening, and we hope you have a great day.